Hello, my name is Atherston Makaure, and I'm a senior trader at Forex Plus. So Forex Plus is a Zimbabwean registered and fully licensed financial market trading company, which offers financial market trading education and any other financial market trading related services. So today, I want to take you through the introduction of financial market trading, which we call Forex trading, and all the basics of Forex trading so that one can get to understand what the industry is all about. So foreign exchange, in short, Forex, what is it? So Forex trading, in short, it is the foreign exchange. It is the simultaneous buying and selling of one currency and selling of another to make a profit, which is done online. So the name Forex is a short name for foreign exchange. So foreign exchange, it involves the exchange of money or the exchange of currencies. So it is done on the Forex market. So what is the Forex market? The Forex market, it is a decentralized global market in which all world currencies trade. It is the largest financial market and the most liquid market in the world, with an average daily trading volume exceeding over 6 trillion. So if we take all the world's stock markets and we combine the average trading volume, if we add them, they never come to this much as to compare to what is traded on the foreign exchange market, with an exchange volume of $6 trillion that is traded on a daily basis. So currencies are traded through a broker or a dealer and are executed in currency pairs. So for example, the euro dollar and the US dollar, or the British pound or the Japanese yen, these are some of the examples of the currency pairs that are exchanged. So unlike any other financial markets, the Forex market or the spot market has neither have a physical location nor a central exchange. So the Forex market, it is a decentralized market, doesn't belong to any government, it doesn't belong to anyone. It is a neutral platform where buyers and sellers, they meet for day-to-day transaction. So the lack of the physical exchange enables the Forex market to operate on a 24-hour, 5 days a week period, that is from Monday to Friday. So what happens exactly when you are trading? So when you're trading, you're simply predicting the direction of the exchange rate. You buy when you think the exchange rate will increase, and you sell when you think the exchange rate is going to decrease. So it's not as easy as it might sound by just buying and selling. This is different from what happens when you go and visit the bank and you have a certain currency. For example, you have the United States dollar and you want to exchange them for the euro, or let's say you've got the United States dollar and you want to exchange them for 7 rand. That process is easy because you just go to the bank and they sell to you or they buy from you at a certain exchange rate that is already determined. But when one decides to be a financial market trader, when one decides to be a trader, what it simply means is you are learning to be a financial market analyst so that you will be able to tell if a currency is going to strengthen or if a currency is going to weaken. We know each and every country's economy is measured by the strength of its currency. So if an economy of a country is underperforming, then its currency is expected to be weak. And if a country's economy is functioning well, then its currency is expected to be strong. So just like what happens on the stock market, if a stock market price is going to rise or fall, or if a commodity price will rise or fall, you take studies to anticipate the possible market direction is going to take. If an asset is going to increase in value or is going to decrease in value, if a stock market is going to rise or is going to fall, if an exchange rate is going to go up or go down, which means we make before the market even moves. So being able to predict where the market is going, that's how you're going to profit. So for you to be able to do this, you need to be a financial market trader. So which means you need to learn to be a trader. So to make it easier for some of you to understand, if you ever traveled overseas, you have made a Forex transaction. So let's say you want to take a trip to France. It means you need to convert your local currency or the currency that you use in your country. For example, in my country, we use the United States dollar. So which means if I want to go and travel to France, I need to change my United States dollars into euros. Because if I go to Europe, in France, I'm not able to buy with the United States dollar because they've got their own local currency. So which means I need to change the US dollars that I have into the euros. So when I do this, when I travel, I either go to the bank or I go to the bureau de change. In every country, in every exit and entry point of every country, there is a bank or there is a bureau de change. This serves the purpose of one person being able to exchange the currency that they have into the local currency into the country that they are visiting. So when you do this, the forex exchange rate between the two currencies is based on the law of supply and demand. So the law of supply and demand determines how many euros you're going to get for the United States dollar and vice versa. And you know the exchange rates, they fluctuate continuously. If you visit the bank and if you look at the exchange rate board, you see that the exchange rates, they constantly change every day, every minute, and every second. So today, let's say, for example, it's a Monday, 1 single euro can get you $0.08. On Tuesday, it might get you $0.10, which means the exchange rate have moved from $0.08 to $0.10. This tiny change may not seem like a big deal, but think of it on a larger scale. A large international company may need to pay overseas employees. Imagine a big supranational company like Toyota. Toyota have got branches that are around the world, which means if Toyota is a Japanese company, and if all payments are processed through Toyota headquarters in Japan, it means if they're going to pay their employees around the world, they're going to do their transactions in Japan using their local currency, which is the Japanese yen. The banking system is going to facilitate the exchange rate to make sure that wherever the recipient of those transactions or of the pay for their employees in different countries is facilitated in the local currencies for each and every particular employee. So if an employee is in Germany, it means in his or her local account, he is going to receive his payout in euros, but the transaction is made by the headquarters in Japan in Japanese yen. So which means an exchange rate have taken place. So which means each and every transaction that is done on the global market on a daily basis contributes to the $6 trillion that is traded every day. because companies, they are procuring raw materials from different countries, and different countries have got different currencies, which means, and when they want to procure raw materials, they are going to do it in their local currency through their banking system, and they're going to do a telegraphic transfer into the recipient account of the company that they're going to procure the raw materials for. And the bank is going to facilitate the exchange of that currency into the currency of the recipient account. So that when it reflects to the account of the recipient account, it is going to be in the currency of that is accepted in the recipient's country. I hope that makes sense. So imagine what that could do to the bottom line if, like the example above, simply exchanging one currency for another cost you more depending on when you do it. So these few pennies add up quickly in both cases. As a traveler or a business owner, may want to hold your money until the foreign exchange rate is more favorable. For example that I've used earlier, if it's on a Monday and if €1 is giving me $0.08, it means if I want to buy the euro to travel to France at an exchange rate of 1:1.08, it means I'm going to get more as compared to when I change my money on Tuesday, when the exchange rate goes to $1.10, which means doing the transaction on Monday was more favorable than doing the transaction on Tuesday, and vice versa. So when one becomes a trader, you need to know when is the good time to buy or when is a good time to sell. So moving on, we need to talk a bit about the history of Forex trading. So Forex trading started during the time of the Babylonians. This system was designed for the currencies and the exchange. In the early times, the goods were being traded for another tangible item. We all know back in the years when the Metal Age began, gold and silver became the tools of transactions. We would exchange goods and services using gold and silver. So this idea became popular during that age. The creation of coins started as well as the political regimes. So when gold became an important trading tool, its use became restricted. Therefore, the result has been brought about by this is that the value of money has diminished. A great panic happened. Then, because people would like to exchange the value of their money for gold, in 1931, the gold standard was removed and the Forex market was born. So although people used to have a very small or no notion at all about it, foreign exchange was then introduced. So citizens will have more monetary stableness and reliability. So through the initiative of the ESA in July 1944, the new world's currency was introduced and initiated, which was the United States dollar. So the United States dollar was introduced as the world's currency. And right now, the United States dollar constitutes of 62% of the world Forex reserve. So during these times, IMF and World Bank and GATT were formed and agreed upon at the Bretton Woods. So the agreement was comprised of the golden standard, which will be equal to $35 per ounce. So other currencies were also fixed with these standards as they were introduced. The reason for this was to avoid destabilizing the monetary crisis. And as I said earlier, the United States dollar constitutes 62% of the world Forex reserve because it was the currency that was made as the world currency. So any other world currencies, they fall on the remaining other percentages. So the United States dollar plays a very big role in our world economy, as it is the currency that have the biggest percentage in the world reserve. Now, so where do the opportunities in the foreign exchange market come from? So just like stocks, you can trade currencies based on what you think its value is or where it's headed. But the big difference with Forex is that you can trade up or down just as easy if you learn how to do it. So if you think a currency will increase in value, you can buy it. And if you think it will decrease, you can sell it. With a market this large, finding a buyer when you are selling and a seller when you are buying is much easier than in any other markets. Maybe you hear on the news that China is devaluing its currency to draw more foreign business into its country. If you think that trend will continue, you could make a forex trade by selling the Chinese currency against another currency, say the United States dollar. The more the Chinese currency devalues against the US dollar, the higher your profits. If the Chinese currency increases in value while you have your sell positions open, then your losses increase and you want to get out of the trade. So moving on, we want to talk about the market participants. Who participates in the market? So in the market, we've got several market participants at all different levels. We've got central banks, we've got large financial companies, we have got big global companies, we have multinational companies, we have got institutional investors, we have got commercial banks, and we've got brokers, and we've got individuals that are also trading in the market. So let's try to describe each and every one of the market participants. So in the Forex market, the biggest player is the super banks. Banks, we can classify them into central banks or commercial banks. But the biggest bank, which is the biggest participant in the market, is the super bank. So the super bank, it is a large financial institution in terms of asset, revenue, scale of activities, but it does not operate only on a global level. So super banks are much larger than any regional bank or any commercial banks. So these are the liquidity providers. This is the banks that determine the interbank rate or the interbank exchange. These are the liquidity providers, which means they provide the liquidity for the market to move up and down. These are banks like Barclays, JP Morgan, Citigroup, and another example of a super bank is UBS Bank. So this is one of the biggest players in the market. Then all other participants, they fall after the super bank. So the super bank is the largest participant in the market. So moving on, we have what you call the central banks. So believe it or not, central banks are having trading departments that monitor the Forex market and from time to time intervene in the market. The Swiss National Bank and the Bank of the Japan are two of the notorious banks for intervening in the market to influence the way their currencies, the Swiss franc and the Japanese yen, will be actually moving. So moreover, sometimes different monetary policies needed market intervention to be implemented. So central banks, they play an important role because each and every country have got a central bank which sets interest rate decisions, they release inflation data, they make monetary policies. All these, they affect an exchange rate of a certain currency in which that is exchanged for, or it affects the economy for that country, thereby affecting that country's currency as well. Moving on, we have what we call high frequency traders. So with high frequency traders, these are computer programs or robots that are designed to buy and sell thousands of trades per second and generate small profits on each trade. They are responsible for the aggressive and instant moves. The market moves when economic news data or economic news releases come out. Then we have what we call the retail forex brokers. Forex brokers are an important part of the interbank market as they have a special trading department as well. Depending on the way a brokerage house is organized and functions, it may route its clients' orders to a liquidity provider for execution, which means the broker acts as a middleman between a retail trader and the interbank market. So the broker plays an important role in bringing the retail traders and connecting them to the interbank market, that is the liquidity provider. The next on our market participants, we've got the retail traders. So to the surprise of many, retail traders are making the smallest and least representative parts of the Forex market. So roughly 5% of the overall Forex market is made from the transactions the retail traders take. However, due to the large size of the overall market, this is quite a chunk of the Forex brokers industry. Moreover, it is increasing every day as more and more people are drawn to the trading circle as worldwide internet access is on the rise. So retail traders are either scalpers involved in short-term oriented trading, looking for small profits that results from quick entries and exits, dailies, or swing traders, that keep their positions open for a few hours to a few days. And investors have a bigger time horizon in mind when it comes to a trade outcome. Brokers are using this information to offer different packages for each category. So retail traders are us individuals that look to profit from the Forex market. So we are the least participant and we contribute a very small effect in as far as moving the financial market is concerned. Then next up, we've got the commercial banks. So with the commercial banks, these are designed treasury departments that deal with exchanging currencies, both on behalf of the bank and for investing purposes. The cost of keeping a cash position is quite high, and the banks are striving to move money as quick as possible and with as little expenses as possible. These banks have various options for that. Either way, park the excess money to the central bank using the overnight facility deposit rate, or will loan to the economy, to the people and the business. Nowadays, with negative rates in many parts of the world, commercial banks are stimulated to lend the money rather than keeping them in the central bank's vault. So moving on, we want to talk about the trading sessions. So trading sessions are times in which business is active in different time zones of the world. In the world, we are in different time zones, and businesses, they conduct in different times, and business hours, they are different in different times. So we have got three major trading sessions that we have in our Forex market. So the three Forex trading sessions are, we have got the Asian session, which starts at past midnight or at midnight, that is GMT plus 2 time, and it closes at 8 a.m. in the morning, GMT plus 2 time. So when it's midnight in GMT+2 time, it is actually 8 a.m. in the morning in Asia, that is in Japan, or in countries in Asia, and that's their normal business hours. That's when their business starts. And we expect monetary exchanges, the financial markets of the countries in Asia, to start to move because it's their active business hours. So after the Asian session, which is the first session of the day, we go to the second session of the day, which is the London session. London session, it starts at 10 a.m. in the morning and it closes at 6 p.m. Towards the end of the day. So the London session is the next session of the day. So when it's 10 a.m. in the morning, GMT+2 time, it's actually 8 a.m. in the morning in London, and business have already started in London, thereby calling it the London session. In other books, you might find it written as Euro session. The Asian session, you might find it also written as Tokyo session. So after the second session of the day, we go on to the New York session. The New York session, it opens at 3 p.m. GMT+2. When it's 3 p.m. GMT+2, it is actually 8 a.m. in the morning in New York. And their business have already started to conduct. That's when their business hour starts. That's why referring it to the New York session. So in the New York session, we expect countries in that session, we expect the United States dollar to be a currency which is mostly traded during that session, because it is the session in which US is active in business. The London session, we expect currencies like the euro, like the pound, to move because they are active. Their business hours are active during the London session. And the Asian session, we expect pairs like the Japanese yen, the Australian dollar, and the New Zealand dollar to move during the Asian session, because that's the time in which business is active in those time zones. So you notice that when Asia closes at 8, waiting for London to open, there is 2 hours in which there is no active session. And when the New York session also closes at 10 p.m., waiting for the Asian session to open on the next day, there's also 2 hours. So these 2 hours, we call it the gap time. The gap time is which there is no active session between the trading sessions. There is no active session between the trading sessions. Then when London opens at 10, closing at 6, end of the day, New York session would have opened at 3 and closing at 10. There is 3 hours in which there are 2 sessions that are active during the same time. We call this the session overlap. This is the most liquid time to trade, in which the market have got bigger moves that appear during this time, because we've got the London session and the New York session being active during the same time. So this we refer to as the session overlap time. So with that said and done, this brings us to the end of the introduction lesson of financial market trading or foreign exchange trading in particular. In our next session, we are looking to discuss more about trading currencies.